Hello friends, how are you? Hopefully everyone is healthy and enthusiastic about learning. Let me introduce myself. I am Enjelika from Accounting Class 23A with NPM 234125052. In this learning video we will discuss a very important topic in the world of accounting, namely cost concepts and financial statements. Don't worry, even though the topic sounds serious, I will explain it in a light and easy to understand language, so that you can follow it comfortably from start to finish. Come on, let's start the discussion. Costs are expenses incurred to obtain resources used in the process of producing goods or services. In accounting, costs are very important because they affect financial statements, especially recorded profit or loss. Dunya et al. 2019, in their book Cost Accounting classify costs based on several criteria, such as the nature of the cost, its relationship to the product, and the period of expenditure. Costs are divided into fixed costs and variable costs. Fixed costs are costs that are not affected by production volume, such as rent and fixed salaries, while variable costs change according to production volume, such as raw materials and labor wages. In addition, costs are also divided into direct costs and indirect costs. Direct costs are costs that can be directly traced to a particular product, such as raw materials and direct labor. Meanwhile, indirect costs, such as factory overhead costs, cannot be directly linked to a particular product. In relation to production, costs are called production costs, while costs related to a certain time period, even though they are not directly related to production, are called period costs, such as administrative and marketing costs. Calculating production costs involves recording all costs used to produce goods or services, and this is important for determining the cost of production and the resulting profit. Financial statements are tools used to provide information about a company's financial position. This report consists of several types, including income statements that show the income, costs, and profit or loss generated by the company during a certain period. Income statements are very important for knowing the company's performance. In addition, the balance sheet describes the position of assets, liabilities, and equity at a certain point in time. Assets are all resources owned, liabilities are debts that must be paid, and equity is capital owned by shareholders. The cash flow statement shows the movement of a company's cash, while the statement of changes in equity records changes that occur in equity during a certain period. The costs recorded in the income statement and balance sheet affect the company's financial performance. Good cost control can increase company profits and produce healthy financial reports. Effective cost control can be done with variance analysis, which compares actual costs with budgets to ensure efficiency in the use of company resources. Okay, that's all the explanation I can convey. Hopefully it can be understood, and see you in the next video.